commission only versus fee-based,
Mm-hmm.
which is kind of in the middle.
Now the commissional products too, there's a range of commissions, I guess, that are paid on different types of products. For example, if you buy a limited partnership interest, there may be a higher commission related to that as
Yes.
opposed to buying stocks. Especially, and there may be some stocks, again, that may have a higher load of some type because there's not as high of a volume for those stocks and
Yes.
so forth.
Most popular securities sold by a broker is a mutual fund. There's a commission on that mutual fund which ranges in a range of 4 to 8% paid to the broker. Bond fund might have less than 4% commission. And that's paid every time the investor buys some of that security.
Mm-hmm.
Straight stocks and bonds will have a bid-ask spread, so there is a profit there for the commission broker. And other investments, including real estate limited partnerships or hedge funds or that kind of other structure, can have a range of commissions from very low to very, very, very high.
Mm-hmm.
By law, all that must be disclosed. So I'm hoping as all of the viewers, as investors, read those documents and understand what the commissions are that they're paying.
Mm-hmm.
There's also fees paid to the money managers. So if you buy a mutual fund, you're paying that mutual fund manager,
Mm-hmm.
and that's listed in the prospectus.
Mm-hmm.
The average cost of a mutual fund is 1.5% per year.
Mm-hmm.
On top of that, you pay transaction expenses. The money manager must buy and sell stocks. So that bid-ask spread is included in that, is added to the average 1.5% fee that you pay to a mutual fund manager. And then there's commissions.
Mm-hmm.
Those commissions can be front-end, back-end, or ongoing.
Yeah.
They
So like a
ensure that you
back-end
hold it.
commission is where the fund sort of pays an amount to the brokerage company, and then I guess there's somehow it decreases over time. I don't really totally understand that, but
So a back-end fee, I mentioned earlier that commissions on a mutual fund might range from 4 to 8%. Let's use an average of 6 as a commission. So as an investor buys a mutual fund with a back-end load, that 6% commission is paid to the selling broker the day of the transaction closes. That commission must be earned back by the mutual fund company in some way. So the investor sees a 6% hit on principal. For every $10,000 they put in the first day, they can only sell it for $9,400 the second day. Mutual fund company is charging a back-end fee of 6% that first 12-month period. At the end of 12 months, that back-end fee goes from 6% down to 5%. At the end of the third year, at the beginning of the third year, it goes down to 4%, et cetera, down until the 7th year where it's 0. Okay?
so what's happening, I guess, is that the company is absorbing the cost as the investor holds it for a longer period of time, but they're paying the commission to the brokerage company.
Yeah, depending upon how it's presented, the investor may think they're paying little or no
Nothing.
commission.
Yeah, all I have to do is hold on to it for 5 years.
Yeah. If you add up the costs of holding an investment portfolio of mutual funds, I spoke about the 1.5% average mutual fund fee plus the transaction plus the commissions. Those fees can total 2.5% to 5% per year.
Wow, 5% is a lot.
Becomes a big number.
Yeah.
As a fee-only advisor, we cannot receive a commission, so nothing we do has any commission costs or added annual fees to it. We tend to use low-load mutual funds for core risk-managed portfolios that we build.
Mm-hmm.
So the total fees for a mutual fund portfolio are going to approach 1.5% to 2%, maybe 2.5%, depending upon what the mix or allocation of mutual funds is.
Mm-hmm.
So we come in normally less expensive than the broker.
Mm-hmm.
And what that means is that the investor makes a profit quicker
Mm-hmm.
or higher.
Okay. Let's see here. Okay, so there are a lot of people say, well, why shouldn't I just be a do-it-yourselfer? I'll just go out and I can use a discount brokerage like a Schwab account or Ameritrade or something, And also I can use a family of mutual funds like a Vanguard or something like that. So why use, because I have to pay you a fee.
Yeah,
Oh my goodness.
yeah.
So why
Thanks.
should I,
Thanks.
why would I want to do that, pay you this god-awful fee when I can do it myself and not have to pay that fee?
Sure. So as a fee-only advisor, we're helping clients do more than just build investment portfolios. What we say is that we're like your personal chief financial officer. So just like the biggest corporation, their job is to make a profit, but they hire a CFO to report to the CEO about how to manage those profits. And we think the individual needs that same help. So we're helping clients coordinate their estate tax planning with their income tax planning, with their investments, and their cash flow. So we're coordinating from all the other professionals, coordinating all that legal, tax, investment information so that the client gets the information that they need to make an informed decision.
Yeah.
So we're hopefully helping clients. At our firm, our client retention is 99%. We're very proud of that. In the brokerage community, it's almost a 25% turnover every year. So brokers are out looking for new customers all the time. We work with clients who trust our advice and counsel, and they stay with us because they see value add. As far as our investments go, yes, we think we're bringing value over and above the choices that you mentioned. So the client can always do things on their own. If they choose to do things on their own, I recommend they do trade at Vanguard, the index funds. There is no evidence that actively traded portfolios outperform index funds over my client's lifetime. So if they stay with the index funds, in my opinion, they'll do better than if they try and use actively traded or retail mutual funds. The funds, the portfolios that we build have a track record of matching or exceeding the performance of those index funds. So we're able to use special institutional mutual funds. Those institutional funds are only available to the biggest pension plans or through fee-only advisors. That relationship allows us to bring to the client something that's not available at the brokerage house or at Vanguard or at the discount trading house.
Okay, well, some of my clients have told me, everybody seems to tell me the same story. I talk to my stockbroker, I talk to Craig, whatever. What I'm hearing is the same. It's diversify and invest long term, and that's all they tell me. And so there's no difference. And so again, so what difference does it make? So how does your philosophy sort of distinguish you from what they're hearing? And maybe again, they're being very selective in their hearing.
Well, yeah, we do tend to hear that which supports what we think originally. So,
Okay.
Yes, it is very, very difficult for investors to understand the complex world of finance. It begins to sound all the same over time. I understand that with investors. I got started with the brokerage community. We've been in the business for a long time. Mike, you and I have known each other for 25, 28 years maybe.
Well, a long time anyway.
And when I got started, I was selling commissionable securities. And that environment did not produce what I saw as the best thing for the client. And so I left that commission business to go into the fee-only business where I could give the advice and counsel that I think clients need. When clients go into the marketplace, they do need to think long term, and that is contrary to the human emotion. So Wall Street, so the human emotion goes like this. When the markets go up, we feel good and we buy more and more. Turns out that clients buy the most at the peak of the market. When markets go down, investors feel worse and worse.